And for more on China's stock market and the overall economic environment in this country, we are joined here in the Beijing studio by Professor Huo Deming from the National School of Development at Peking University. Welcome, Professor. Meanwhile, in Washington, D.C., we are joined by Mr. Nicholas Lardy, a senior fellow at the Peterson Institute for International Economics. Welcome to our program, Mr. Lardy. It's great to see you here, in fact, on our program. First of all, gentlemen, a very general question for both of you. Professor Huo, have the policies worked? Stabilizing fund, 120B. Meanwhile, suspension of IPO and encouraging executive or state-owned enterprises to buy in the shares of their own companies, together with some of the others, with the recent announcement of prudent monetary policy for the second half of this year. Will they work? Have they worked?
Well, it did stabilize the stock market a couple of weeks ago. And I think the stock market is really a dynamic market. So when you ask whether it will stabilize the market, the answer is I don't know. But I think the government is trying to learn how to deal with the new kind of stock market, especially with the leverage that was not in the market before. So for instance, in 2007, the stock index reached 6,000 and it dropped down to 1,600. So then there is no such huge cry out of the stock market. But what happened now is that this leverage of things is something new. And we all know in the financial world, when you have something new, you're bound to have some exuberance.
Mr. Lardy, it is no secret that government could come into the certain unusual times of the stock market when it's experiencing such a dramatic drop just to stabilize the market. But what do you think about the roles so far, particularly the roles of the policy so far?
Well, I think in an ideal world, the government should not be intervening that, you should have price discovery based on, supply and demand in the market. Obviously, given the precipitous decline that started a month ago, the government didn't feel it wanted to live with a 30% decline. Remember, the decline in 2007 was much greater, but it occurred over a much longer period of time. So I think the government felt it had to intervene. I think it's unclear whether or not that intervention will be successful. And clearly, weighing on investors' minds now is what is the government going to do with the large accumulation of stock that it has purchased in recent trading sessions? Is this going to come back onto the market? Is this going to be a permanent stabilization fund? And in other words, I think it does create considerable uncertainty in the minds of investors. When will the government lighten up its holdings, and what will the effect on prices be?
Professor Huo, of course, you are not reading the mind of the government, and you are not necessarily a member of the policymaker, but what is your reading of some of the possible steps of the government in terms of what we will do with the already purchased stocks, and also its impact having on the market? Go ahead, sir.
One thing that the government is trying to do, as the clip just said, the government is trying to provide the liquidities. What do we mean by liquidities? Well, we know the real world, the real economy is not doing that good. But in the stock market, also in the financial market, you don't want to face the situation where people do have stocks and they want to sell, and all of a sudden the market just freeze. So liquidity, my translation from academic world, is that, well, there's some liquidity in China, especially in the developing economy like China. All of a sudden, the dry up of the liquidity is not a good thing. So let's provide with some basic liquidities so that when people want to buy or sell stocks, they have a way to turn to. Otherwise, you face a dead, dry market. That's going to hurt the economy.
Mr. Lardy, I want you to respond to that kind of theory. And secondly, the very important argument is whether the equities market is that important in China anyway, because it's not necessarily that people are saying stock market is reflecting the real economy. And secondly, for an economy like China, which of course is experiencing such a financial reform transition, the stock market does not necessarily even further to reflect the realities of the economy. So I want you to explain your concept of the stock market and also the argument coming from Professor Huo here in Beijing. Mr. Lardy.
Well, I think the premise of your question is absolutely correct. If you go back the last 20 years, there's been very little connection between stock prices and the underlying performance of the economy. Remember, in the boom, up until a month ago, the economy was slowing down, profit growth was slower, certain parts of the economy were under stress, but prices on the market were shooting ahead. That's typical of what's been the case in China over the last 20 years. The other very important factor to take into account is that very little real economic activity is being financed by money raised in the stock market. Even in the boom period in the first half of this year, the IPO value only provided about 5% of the credit expansion in the Chinese economy. So it's a very, very small slice of the overall financing capacity of the economy, which simply reminds us that China is still a very, very bank-dominated financial system, and the growth of credit from the banking system is very important, much more important than the volume and the value of IPOs.
And therefore, would this really have much on the real economy and also on the future of China's stock market? What's happening with the Chinese government policies and also the investors' attitudes and confidence about the stock market? Mr. Lardy, once again.
Well, I think I'm not in the best position to judge confidence, but I think confidence must be very substantially reduced given the volatility. I think one of the main lessons of this episode is that China should be more restrictive in the use of leverage and the use of margin. As your guest pointed out, that was a major cause of the precipitous decline once the correction got underway. And I think there's room for significant improvement. The CSRC is not looking very good at this point.
Professor Huo, there are different views coming from different economists about the policies, about the real indicators of the economy, and of course also about the current situation of the stock market. What exactly is your view? In your view, sir, are we still in this quite a long process of the government trying to find the right degree of dealing with the stock market and the equities market? Or are we reaching already a pivotal point? I think that's an important point that you should make clear first.
Okay. As I've been observing China since the start of, well, the beginning of the 80s. Now, whenever time we talk about pivot, I mean, look, we have so many pivots, and I don't think that matters really. What matters is that for China, really the financial world is dominated by this indirect finance, namely banks. As long as banks stays, as long as it's safe, deposit all there, as long as all this is quiet, I don't think it really matters in the stock market that much. But having said that, we all know for a proper or developed country, nations in the world, we all see a very good, at least healthy direct finance that's happening. So we know we're going to get there, but how long before we pass this transition?
Okay.
5, 10 years? I don't think so. I think we'll take 20 years for China to really learn, either private sectors or the government knows how to dealing with this kind of situation.
Okay, it's very interesting. Mr. Lardy, of course, it's no secret that the Feds could also come in at certain times in buying in certain company stocks just to stabilize the market. But I'm not trying to compare China's case to that of the United States, because this is totally two different markets that we are talking about. And China, as Professor Huo illustrated, is in this relatively long process of doing its financial reforms. And many see what's happening now in the stock market, related to the stock market. It's a reflection of that testing and learning process. Mr. Lardy, what do you think has been the process so far? How will this specific rounds of government versus the stock market in a way could help China to be more mature in terms of its policies and also in terms of its future financial reform processes? Mr. Lardy.
Well, I think there are a number of things that are fairly clear. I've already mentioned. I think the regulator, the Chinese Securities Regulatory Commission, needs to do a better job in regulating the market and getting rid of trading abuses and certain other practices that you don't find in more mature financial markets. I think secondly, China needs to transition from a market that is very, very retail dominated to one in which institutional investors play a much greater role. They tend to be more sophisticated, longer term in their outlook. And so if we had pension funds, insurance companies, mutual funds playing a greater role in the market, then I think you'd see more stability and the development of a market that would serve the real economy more effectively than it has so far.
Professor Huo, what do you think about the role of the institutional investors? Will that necessarily make things much better or stabilize?
It is a long argument that in China, we all know there are so many private investors, not necessarily institutional investors. I guess for a transition economy in China where you're bombarded with every day, there are so many new things, enterprises or investing profitable opportunities coming out. I don't think any institutional investors is expert enough to pick out the winners. So in a way that it takes time to train the economy. You know what train the investors is the institutional or private investors. For instance, I'm a private investor, but I don't think any institutional investor, they know much better than I do. So in a way that we all try this, but this happened in US or in UK 200 years ago. So for transition economy, I should say, everything is uncertain, and I'm not surprised.
We are not a program dealing specifically with the stock market, but I have to ask this question so that to make our program more credible, at least to some of the investors. Of course, anything that's being given here is only personal views, so I would ask both of you to give some personal opinions about what the investors' attitude should be, whether institutional or private, at this moment toward the Chinese market. Mr. Lardy, you've been dealing with China for such a long time. There are ups and downs. What about your view here?
Well, I would say that the investors should really be looking at the underlying economy and how well it's performing. And I think there are actually some very positive signs that the economy is going to do even a little bit better in the second half of this year. So I think a lot of the commentary that the market's down because of weakness in the economy and the monthly profit figures. I mean, for example, the decline in profits that was reported a few days ago is entirely in the mining sector of the economy, which is a very, very mining and petroleum and so forth.
I see.
The manufacturing sector is much stronger than you'd expect for an economy that has slowed down as much as China has.
Looking at the bigger picture, it seems that what Mr. Lardy has been suggesting. Professor Huo, very briefly from you before we run out of time.
Well, the investors, in terms of institutional investors, I think they have learned a lot from Chinese government this time. So I think in the future, they will be more careful in dealing with Chinese stock market.
All right. Professor Huo Deming from Peking University and Mr. Nicholas Lardy from the Peterson Institute for International Economics. Thank you so much, gentlemen, for being with us.